Okay, retail industry. We already discussed retail industry a few months before, and also we looked at shoe industry, which was very similar to retail industry, but still today we're going to look at hardline of the retail industry. So it's kind of a different branch of it. Now, first of all, it's really difficult to find company which is just purely hardline. Again, hardline is retail industry. Hardline is division done by value lines. So if you go to Finviz, Morningstar, you will probably find this company kind of maybe in different type of name of industry. So each analytical company has sometimes their own classification. So okay, now we can very easily find that despite they are in this industry, they still have products from different industries. So part of their product could be retail softline, okay, and some of them could be different. So, and it might confuse you. So probably value line put this particular company in retail industry hardline because majority of their products, okay, in this area. And hardline, it means like whatever is hard. So furnishing, most of the products of Williams Sonoma is like furnishing products. Okay, now that's the first thing. Secondly, it is quite simple business for understanding. If you look at some IT companies, the structure of the business not clear for a lot of people, so it's invisible. With retail industry, it's pretty straightforward. So you can see, okay, they have so many shops, they have so much traffic. If they don't have shops, they probably have online store and they sell through online store. How do they do that? So it's pretty easy to see and understand. So that's a good thing for us. At the same time, you have to understand it drives a lot of people to invest in this particular industry. And if you try to look at multiples which people are paying for companies included in this industry, you will find usually they're higher. Okay, so if you compare with other industries. Then another common thing about companies in this industry that they follow the same business cycle. So sometimes you will see that they have very good sales in one quarter and then bad sales in another quarter. And it helps you to predict what is going to happen with your company. Imagine that you know 8 companies which work in the sector, you follow them, and you know that all of them, they're going to report within the next 2 weeks. And assuming that you follow one of the companies which to report at the end of this kind of cycle, and then you see that one of their competitors and maybe second competitor announced their earnings, then they tell, oh, we had worse than expected results because the traffic of customers was much less than we expected. And then you can see, you can predict that your company most likely will have same results. Okay, so it's kind of helps you to make decision before that. And if you pay attention, if you start paying attention to some companies, you will see that a lot of retail companies, they move in the same way. So if you see one company reported badly, then you can see that quite few other companies, they start dropping in price instantly, because that's what people do. They follow the first company, they see it, that it's has bad earnings, and they assume that other company has bad earnings and they start to sell it off. Okay, that's a kind of a good thing to understand. Then this industry has high competition, and it's very easy to enter this. It's very easy to open the store and buy some products from China, for example, and start selling it, or maybe from local producers. So it's pretty straightforward. You don't have to have a lot of knowledge and like quite comprehensive, although more and more IT structure integrated in these businesses, a lot of online stores integrated in these businesses, and it's more difficult now to compete, but still it's pretty easy to enter this industry, much easier than for example biotech companies which were analyzed before, or pharmaceutical companies which were analyzed before as well. Okay, the next thing is higher level of expenses. Now if you compare with some other industries, they have high, would say, investment cost. For example, if you look at movie industry, you will see that Disney has to spend quite significant amount of money to produce the movie and market the movie before they actually get any revenue. Okay, similar thing happened with the biotech companies. Whereas with the invest in retail industry, they have constant high level of expenses because in order to create good volume of sales, they have to place their shops in a high traffic area. And usually, if you look at industry, it has to be city center, or they have to go into retail shopping kind of like villages, you know. So when you go and you can see 10, 15 companies, they put their shops close by somewhere outside of town where people can drive in one place. But at the same time, yes, their rent is cheaper, but they drive people to their competitors. For example, when I was buying Mark furniture, I went to buy it in one store and then I bought it in completely different one. Okay, because they're all in the same location. It's good for customer. It's not so good for sometimes for company if they cannot compete with price or whatever, they don't have competitive advantage. Okay, and then low loyalty of customers to unfamiliar brands, and actually for a lot of brands. I mean, if you decide to buy some chairs, you don't care what kind of brand it is. I wouldn't tell you what chairs I have, what brand. And next time I'm going to buy chairs, I'm not going to care about brand at all, or table, or sofa, or something else. And that's why it's really, really important to understand that when you invest in a company, they don't have this brand loyalty. Like, for example, when you buy laser blade and you know that you're going to go and buy Gillette, okay, regardless where you are and how much it costs, you're still buying it. But when you buy furniture, you probably don't care really about the brand level. So that's why it is important to understand. Now, difference between soft line and hard line industry, it looks like small, but I believe it's quite significant. In order to sell, like in soft line industry, they have to design new clothes, and then they have to manufacture these clothes, and then they have to bring it to the store. And it's kind of the chance if they sell it or not sell it. Okay, they are risking it here. And of course, what can happen that after that, the inventory, like I mean, soft line industry stores, the inventory will go up, and after that, they cannot sell it off. With retail industry, it's different sometimes. If you buy furniture, quite often you go to the store, you buy it, but it's not delivered to you. It has to be manufactured first, and it's quite a lot of situations like that. And you have to wait up to 3 weeks. Very often they tell you that it's on a warehouse, but in reality, this product even not manufactured yet. Okay, what they do, they instantly submit their order. Within 1 day, this sofa is manufactured, and then it takes 2 to 3 weeks to deliver it to you. Okay, if the store is located, for example, in United States and United States customer, so the period is smaller, but the price is higher. If it's manufactured somewhere in, let's say, in Mexico, and it's probably price is cheaper, but delivery time would be longer. But it is a good thing for us as investors, because we know that company is not going to increase their stock volume quite a lot. And also, if they even have the stock, they have limited items of this particular like design. So if they have one sofa there which is on display in the store, or maybe have few on warehouse in order to provide some kind of sales, and if they stuck with that, it's not like thousands of different designs of, like, I mean, thousands of t-shirts or shorts which cannot be sold after that. Okay, so that's a good thing which I found in this particular industry. It helps to compete with other businesses. Okay, of course, downside of would say this type of hardline industry, because they include very often expensive products. Like sofas, they could be from $500 up to $5,000. Kitchens, it's even more expensive. If you buy chairs, tables, they would be in hundreds of dollars. If you go to softline industry, where you can see some products, they cost $3, $5 up to $100. Okay, and despite that when the economy is going to kind of recession, all of them suffer. But Hardline, I believe, will suffer more because their product is more expensive. And I presume that if your your Hardline, you're not going to buy new sofa or you're not going to buy a new kitchen if at the moment is recession and your job is under risk and something like that. So of course, this type of businesses, they will suffer much more. Okay, this is kind of thing which is important. Okay, if you go to value line, you will see like information about retail hardline industry. We can see that at the moment value line tells us that's rank 19. Rank 19 is pretty low rank. They all together have about 96 different industries, and 19 is pretty good. So value line believes that as industry as a whole, it has more potential to grow within the next 12 months than other industries. Okay, so it's pretty good for us. Now, if we look at the size of WSM, we can see that it's not the biggest one, but not the smallest one. So it's pretty big size of the company as well. And we can see that some of companies, they're bigger. In other two companies, which I will ask you to analyze on your own, it's SIG, okay, Signet, and BBBY, Bed Bath & Beyond. So they're similar size as WSM. Okay, they would be interesting. Who came last night for our club meeting? You probably analyzed this company. If you weren't there, so please do it yourself. So it would be interesting to do it. Now, if you read this report, you will notice that traffic to physical location declined 12%. November and December. It's in general in industry. And that's actually a very good indicator that online sales growing and offline sales decreasing because of traffic. It tells us that more and more customers, they start buying online. And when we analyze Williams Sonoma, you will see that 51% of their sales is driven by online and catalog sales, which is fantastic for us. Like, I mean, if we invest in a company like that, because it means that they're moving from offline to online industry, and they have quite huge volume in trades there. And remember that like cost of running online store is much less than running offline store based on the like discussed previously situations. Okay, and if you go, there is an index like ETF, retail ETF. The ticker is XRT. It follows companies, retail companies included in S&P 500, and that's what we can see. Starting from February 2016, it has one roll, two roll, and now it's touched again like this bottom roll, and we can see that it started climbing up. Within a couple of days, it's kind of playing here around. So it might do the similar thing like here. We can see that it's touched this point, went up, and then again tested the same level. Similar situation we can see here, up, then went down again on the same level, and then it started growing. So easily enough, what I can see, it might repeat it, similar situation, and might go to about $42. What does it mean for us? It means that companies included in this ETF, they're going to go down in price. So, and it means that the company which we're looking at now, WSM, it might go down and then already go up if it's included in this index, and will go follow. And also we see that this ETF at the moment is close to like MACD and RSI neutral, but stochastic is already above 70. Okay, so 73.9. So, and we can see it's turned around. So it's at the moment it's not clear what ETF is going to do, but you have to take into consideration that, because it can go up and it can go from 43 to 48. So it's nearly what 15%, but it still can go down about 5%. Right. So that's the